Good morning, lazy traders. In today's video, this is going to be the last introductory video before I get started with actual trading on this platform to show the success rate or the ability of trading on dividend capture trading. So for right now, but I'm going to show the difference between long-term investing, day trading, and dividend capture trading, and just kind of sort of compare the three different techniques side by side. So doing a little Google research, this is what I came up with. The typical profit percentage for individual investors can range from 10 to 15% annually, depending on the market conditions, skill level, risk tolerance, while some investors may achieve higher returns through aggressive strategies. Long-term investors generally aim for more stable gains. Volatility, timing, and research are key factors in determining profit. It's important to understand that losses are common for beginners, so proper risk management is crucial. So for a long-term investor, price matters as well as the strength of the company. So if Facebook dropped 50 or 60% today, I'd probably buy Facebook or Meta. Just like with any other company, if it goes below a valuation level, then that would be a key indication that I would want to pick up some shares. Day trading has a high attrition rate of 40% of day traders quit within a month, and only 13% remain after 3 years. Low success rate. Only 13% day traders maintain profitability over 6 months, and a mere 1% succeed over 5 years. Day trading is basically just gambling. You're basically betting that the stock is going to go up in your favor, maybe like 1/3% or something like that, and you're in and you're out within a matter of a few seconds, a few minutes or something. So basically you're treating the market like a casino. Dividend capture trading, which is the strategy that we are experimenting with on this platform, is a little like that on the success rate with day trading. The dividend capture strategy is not likely to be profitable for the average investor. It's a short-term trading strategy that's tax inefficient and doesn't perform other long-term techniques. Here are some reasons why dividend capture trading may not be successful. Tax efficiency. Dividend capture trading strategies are not tax efficient. Qualified dividends. Capture strategies rarely meet the condition of holding a stock for at least 60 days during the 121-day period before the EX dividend date. This condition is required for a dividend to be considered as a qualified and receive capital gains treatment. Stock price decline is another issue. Obviously, a trade may not be profitable if the stock price declines more than the dividend amount. However, dividend trading can be effective in certain markets. It can generate high income with minimal capital because investors focus on the next dividend payment. So in this strategy, I'm looking at maybe like 6 different things as considerations as a dividend capture trader. And if you're going to do this on your own, this might be something that you might want to do too. So first, goals of a capture trader should parallel with the industry the trader is trading in. For example, if the growth rate of the industry I target is retail, REIT, and consumer staples at 14.5%, 9.5%, and 12% on a 10-year average, then I'd want to beat that amount by about 12% average on my trades. 2, aim higher if you think you can use benchmark averages. S&P 500 is 15% for a 10-year average, 10.5% for the past 100 years. NASDAQ is 25% over a 10-year average for return. The idea is that you're kind of sort of aiming a little higher if you're successful at dividend capture trading for the long term. Then you might want to aim a little higher for maybe the S&P 500 or see if you can compete with the NASDAQ just to see if you can do it. 3, mix seasonal trading with capture trading during March, April, or September, October. 25% in capture trading, 75% in cash, waiting for the potential correction. In the previous video, I said that you'll want to have a little bit of money set aside for seasonal trading. So basically, during the seasons of like March, April, and September, October, there's usually a correction, a 10 to 20% correction in the market, offering you the opportunity to really buy in at some cheaper prices. You don't really want to capture trade during these times either, because you're taking on the risk of going in through a dip. So putting some money aside, putting 3/4 of your money aside to be able to take advantage of that may not be such a bad idea. 4, trade only best-in-class companies to mitigate loss. These companies are strong, they have stable prices, they have good revenue growth. These are the kinds of companies that you would want to own for the long term, and you could possibly use to capture trade in the short term. 5, if bad timing happens, wait it out. Best companies return to value. Hey, the top dog always wins, right? So just keep that in mind. 6, use Roth IRA for tax reasons. Stocks sold before 61 to 120 days holding period that pay dividends get taxed at the higher ordinary income tax rate, currently at 37%, the highest, could change in the next year, instead of the qualified dividends as high as a capital gains tax as high as 20%, the highest. So these tax structures are potentially going to change if we get a different if we keep the same party in office. So if we get the other party in office, then the tax structure might actually stay the same. So that's something to consider, but I would definitely use the Roth IRA for sure in dividend capture trading, or really any trading you do, because Roth IRA is a tax-free system. You pay taxes on the money going into the Roth, but you don't pay taxes on anything you do inside of the Roth. So that would definitely be to your advantage if you're going to trade stocks, and you don't have to worry about reporting each and every single buy and sell or amount of dividends you collect in that entire year for that activity. With that, that's it for this video. Stay lazy.